So thanks everybody for joining. I don't know, can you all see my screen? Okay, great. Thanks so much for joining today. A little info just for people who don't know me. My name is Rachel Hager, and I have a tax consulting firm here in Stamford, Connecticut. I've had the company here now for not quite a year, but a year in May of 2021. Prior to that, I've worked at large companies in their tax departments, as well as with small businesses and individuals. I have over 20 years of experience, so I've been doing this for a long time. And currently, I'm focusing more on small businesses and individuals right now, because that is the busy time that we are in right now, and we have a lot of deadlines coming up. So that's a little bit about me. Today, I thought we would just jump right in, and I'm going to talk today about small businesses because I think that's the most applicable to this group. And I thought we would start off by talking about business entity and how you structure your business and the tax implications around that. We'll go then into due dates and deadlines that are coming up pretty quickly. Some have already passed. And then we'll talk about some common tax deductions for small businesses. So hopefully you're already maybe aware of many of these, but if not, it's not too late to start putting things in place. And then I'll just give a brief overview on a couple of things that I'm seeing now related to taxes and COVID, things that happened through the COVID CARES Act and that we're seeing now on returns as we're preparing the returns for 2020. Okay, so this slide has a lot going on in it. I'm just gonna start by saying when you start operating your business, you have to pick how you're gonna structure your business. And when you pick how you structure your business, there's going to be tax implications in that. It's going to depend on, what forms you file, the due dates of those returns. There's a lot of other things that go on in terms of how you would pick your business structure, like liability. Do you want personal liability, or do you want to be protected and only have your business assets, have, no personal liability? And there's other, a lot of non-tax reasons why you may pick one structure over another. But I put up here 5 of the most common that I see when I work with small businesses in terms of, when people choose structures. So I'm going to start actually at the bottom, because the LLC company is not actually a taxable entity. You can choose to be an LLC company. And when you do that, you set it up, you then have the option to choose how you want to be taxed. You can be taxed as any one of the 4 above. So you can choose to be an S Corp, you can choose to be a C Corp, you can choose to be taxed as a partnership or a sole proprietor. So I just wanted to be clear that the LLC is not a taxing entity in and of itself, but you can actually have your choice as to how you choose to be taxed. So then if we go up to the top, the sole proprietor, the partnership, and the S Corp, those 3, I'm going to talk about those first before I get into the C Corp, because those 3 taxing entities are what we call in the tax world flow-throughs. And what that means is that those entities do not get taxed at the entity level. There's no partnership tax rate and no partnership tax liability. What happens is you calculate your taxable income or loss, and then you pick up your pro rata share of that income or loss, which then flows through to your personal tax return, which is your 1040. So you're not actually paying a partnership tax return or tax liability rather. The return is just there for you to calculate what your profit or loss would be, and then you pick it up on your 1040 through a form called a Schedule K1. If you're a sole proprietor, that's also a flow through, but there's no separate entity for that. You would just file your normal 1040, and you would attach what's called a Schedule C. And the Schedule C is part of the 1040, and it would lay out all of your business income and business tax deductions. The S Corp also is a separate form. It's an 1120S. So you do have to file a separate form. It's not part of your 1040. But again, similar to the partnership, you would just calculate your taxable income or loss, and then you would pick up your share of that. So there may be other shareholders in your S Corp. Everybody would pick up their percentage share. Now the C Corp is a little bit different, and that's why I sort of saved it for last. The C Corp actually is its own taxing entity. So any income that you earn in your C Corp is actually taxed at a 21% tax rate. And that is the C Corp's liability, not yours. It does not flow through to you. So it's different from the others that we just talked about. The company, the corporation, will pay that 21% tax, and then the rest of the earnings will just sit there and stay there. If you as a shareholder want to get money out of that C Corp, you either have to take a dividend and then you're taxed again, which is not great, or you could pay yourself a salary. So in general, I don't see many small businesses that are C Corps. There are some, and again, it will depend on other reasons why. There might be other reasons why you want to be a C Corp that might have nothing to do with tax. But from a tax perspective, you don't see a lot of small businesses because mostly small businesses need access to their money quickly. And if you do that as a C Corp, you're going to get taxed at the corporate rate of 21, and then you're going to get taxed again when you take a dividend. So usually I see S Corps, partnerships, and so forth. Okay, moving on to business filing due dates. If you have employees in your business, you have to give them, you're required to give them a W-2 for the full year, and those were due either, usually it's the end of January, early February. I think this year it was February 1st. So those should have been provided to employees. If you have people, service providers that you use that are not employees, but you pay them $600 or more cumulatively in 1 year, you will need to provide them with a 1099. Now, you don't always have to provide a 1099. There's rules of when you should. There's exceptions to those rules, and then there's exceptions to those exceptions. It's a little bit more involved than I want to get into today, but if you use service providers like lawyers, maybe you had some marketing experts helping you out, whatever the case may be, if you paid them $600 or more, you probably want to look into whether you need to file a 1099 or whether you should have filed a 1099. Now, if you're late, it's okay, you can still file, but there may be some, interest or penalties because you are late. Okay, the next deadline is for filing tax returns, and these are for calendar year taxpayers. So for taxpayers who choose 12/31 as their year end, we are quickly approaching the partnership and S Corp due date, which is March 15th, which is only 11 days from today. So if you file a 1065, if you're a partnership, or if you file an 1120S as an S Corp, those tax returns are due March 15th. If you're not ready, you can extend them for 6 months, but you do need to file an extension form. And it's not something that I see very commonly, actually. It's usually, people are usually pretty ready and want to get these things filed by March 15th. If you are an individual as a sole proprietor and you're going to do a Schedule C with your 1040, which is your personal return, that is due April 15th. And if you're a C Corp, you file an 1120 and that will be due also April 15th. You can also extend those if you're not ready. I don't, actually I do see 1040s extended quite frequently if they're super complicated, as well as 1120s. But those are due April 15th. And then for estimated payments, when you're an employee, you sort of have the luxury that you have the employer withholding your federal and your state income taxes withholdings that go to the IRS in the state that you reside in. When you're self-employed, you don't have that. Nobody's withholding taxes, so you're required to make payments in. If you believe that your tax is going to be more than $1,000 per year, you are required to make what's called estimated payments throughout the year in 4 quarterly installments. You usually have to do that for the IRS, for your federal payments, for the state you're domiciled in. For most of us, that's Connecticut. And then if you have employees, you would need to do Medicare and Social Security, which is FICA. If you don't pay in the appropriate amount, there can be penalties on underpayment. So you do want to make sure that you're checking that. And one thing I do a lot for clients is I suggest that they send me their profit and loss statement, through QuickBooks or Excel or however you do it for the quarters. So, March 31st, if you send that, and have your accountant look at that in early April to sort of see, okay, this is what you made for the year. This looks like you might need to make a payment. And the IRS also allows you to sort of base it on prior years. So if you don't really, if you're seasonal business, and let's say you make most of your money in second quarter, you can base some estimated payments on prior year in order to try to waive some of those penalties. Okay, so tax deductions. Tax deductions are, basically they're the expenses from your profit and loss, but not all of your expenses are always going to be deductible for tax purposes. And then there's some expenses that actually you might be able to get that you didn't take on your in your accounting books. So they lower your taxable income. They're obviously very good. We want as many good tax deductions as we can get. And the taxable income is the base at which the tax rate will be applied. So, the more deductions we have, the better it is. It's really good to keep good records. I highly encourage people not to mix their business accounts with their personal accounts. It can get pretty hairy. If I do know some clients who have a bank account and they do everything in there because they're usually acting as sole proprietors and there isn't that much separation. But if you don't keep your personal separate, come tax time, it's really challenging for you and for your accountant. And then, if you are audited, you always want to have clean records and be able to support the deductions you took, because the IRS has 3 years to audit you. And, what they're going to be poking at is your deductions. They're going to want to be making sure that you have good support, that they're reasonable, and that you're consistently doing the same thing every year in terms of how you're calculating them and what you're doing. This really comes into play more so with deductions that have some personal element to it as well as some business element to it. And that's where things can get a little bit tricky sometimes. So I'm going to talk a little bit about that now. So some of the more common deductions that I see are shown out here. The first 3, business travel, vehicle use, and home office. These are the top 3 that can get a little tricky when you're sorting out your business and your personal. I think for business travel, I think everyone knows, right? Let's say you have a conference in Florida and it's a conference for, business development or business continuing education, whatever it may be. But you figure, you know what, I'm going to tack on a couple of extra days. It's in Orlando and I'm going to take the family to Disney World. And isn't that great? And that is great. And you can do that. But you have to be in terms of what's a business deduction and what's not. And my rule of thumb really is if you can pay for something and it would be paid for no matter what, even if your family wasn't with you, then it's fully deductible. So your airfare, you don't have to allocate your airfare and say half is a business expense and half is a personal expense. The full airfare is what it is. It's whether for you, you're traveling that for the conference, it would be the same if you were tacking on 2 days for personal or not. So that full amount for you is deductible, but the full amount for your family is not. The hotel that you're staying in the nights of the conference, you're going to pay the same thing if it's just you or if it's you and your family. So fully deductible. The dinners out at Disney World, not. So again, just it's pretty I think self-explanatory, but it is good because sometimes people don't know what they can deduct and what they can't. As far as your vehicle use, I think we all use our cars, sometimes for business and sometimes for personal. I tend to like just tracking my mileage, my business mileage. And then at the end of the year, I take my business mileage over my total mileage. And then I basically allocate all of my expenses that I put into my car and I take that ratio. And that's one way to do it. There's other ways to do it. And again, I think it's really important, whatever way you choose to do it, that you're consistent and you do the same thing each year. You don't want to be switching your methodology. And again, you want to be reasonable. And those are the key things, I think, when you're facing an IRS agent and they're asking you something. If they see the same method every year, they're much more likely to say, this is good, this is reasonable, and this is clean. As far as the home office deduction, similar to vehicle use, there's a couple of ways you could do it. I like the way you take your square footage of your office over your total square footage of your home. You can list out all of the different expenses that go into your home, such as insurance, utilities, internet, and take a percentage of those. And those are good, valid business expenses. Meals and entertainment. Meals are generally 50% deductible, 50% not deductible. Entertainment used to be the same, but they changed that. I think that was in the 17 Tax Act. And now it is 100% not deductible. So taking out clients, for entertainment, taking them to a concert, etc., that will not be deductible. Any money that you spend on business assets, computers, printers, scanners, furnitures and fixtures, any of all that, that gets depreciated over the life of the asset. However, there are two sections in the code that allow you to depreciate it very quickly. Section 179 as well as depreciation. So you generally get those deductions right in the year that you make the purchase. There's a threshold limit of how much you can take as a first year deduction, but it's pretty high, and most small businesses can qualify and generally take all of their purchases, take those deductions in the first year, as opposed to amortizing those expenses over the life of the asset, which is the normal way depreciation works. The QBI, the Qualified Business Income Deduction, is new also from the Tax Jobs Act of 17. It's a pretty cool deduction. I've seen people save a lot of money on that. It's related to the business income that your business is earning, but you actually take that deduction on your 1040, on your personal return. It does phase out. It has income phase out limitations. So when you're looking at your 1040, however much QBI you get, I think the most you can get is 20% of your business income, but it will phase out depending on how much other income is on your return. So if you're filing married, filing joint, for and your spouse works and earns, maybe a lot of money, you might get phased out even if your business isn't earning super tons of money, because it looks at all of the income on your 1040, not just your business income. The other limitation on the QBI is some services, some actual trades or business are considered specified service trade or businesses, and they may be limited. It doesn't mean you can't take the deduction, but get as much if you're not a specified service trade or business. And those types of businesses are generally CPAs, attorneys, I think healthcare workers. There's a whole long list, and sometimes it can be tricky to understand whether that SSTB applies to your business or not. So that is a big question that we kind of look at a lot. The final one that I want to just briefly mention is retirement plan contributions. These are good to remember to do because, again, when you're an employee, you can contribute to a 401k and it's automatically deducted from your paycheck. Not the case when you're self-employed. So you have to remember to make your retirement plan contributions. And the good news about that is you can actually make them up until the date you file your tax return. So if you're a sole proprietor, for example, and you file a Schedule C, those returns are not due until April 15th. You can see how your business did now, right? So if you're doing a draft return for yourself, or you're having your accountant do a draft tax return, and you see that you actually owe money and you have taxable income there, you can say, well, you know what? I'm going to make a retirement plan contribution now, and you can still deduct that on your 2020 tax return. So you can make that contribution on April 14th or even April 15th, as long as you make it before you file your return and take that deduction on your return. So those are good. And there's a number of retirement plans that are specific to small businesses. One is a STEP, one is, I think, solo 401k, an IRA, and you can have your company, create these, and then you can sock away a lot. I think the max might have been $57,000 for 2020. So forget about those retirement plan contributions. They're great deductions. They're obviously saving for retirement, which is important, and sometimes we can forget to do that. As far as COVID goes, a couple of interesting things I thought happened this year. So one was the filing deadlines were extended, as probably you all know. Thankfully, that's not happening this year. We're on track to file on March 15th and April 15th. One thing I thought was pretty cool was normally, again, getting back to your retirement, normally the IRS, they don't want you to take money out of your retirement early. So generally, if you take money out of your retirement prior to turning 59 and a half years old, they will hit you with a 10% penalty. They want to encourage saving. But this year, because of COVID, they knew people needed access to their cash. So they allowed people to take distributions up to $100,000 a year, and you would not get any 10% penalty, which was nice. And in addition to that, they're allowing people to be taxed on that income over 3 years. So if you took out $100,000, you would only have to pick up $33,000 in 2020. And you can pick up the next $33,000 next year and the next $33,000 in the year after. If you can pay that money back within that 3-year period, you can just file amended returns and get your tax and get your refunds back fairly easily. So that was something that was in there that we're seeing a lot of people did. We're doing tax returns now and seeing that people took out these distributions and now are only taxed on a third of it and had no penalties, which is really helpful. And then the last thing we're seeing is this Paycheck Protection Program. So a lot of us had took out some loans for the Paycheck Protection Program to just keep the lights on. The loan forgiveness of that is not taxable income, so that's really good. And the other benefit of that is that the expenses that you use to pay, that you use that money to pay for, those are also still deductible, which is really nice because usually the IRS likes parity. If the forgiveness will not be taxed, will not be income, generally the deductions will be disallowed. They're not going to let you sort of have it both ways. But in this case, they are. So you're sort of getting a double benefit for people who took that loan. I have a little note here about bookkeeping because one thing that I am seeing a lot of is a lot of people don't know how to record the PPP loans. It's not income to you when you receive it. So a lot of people receive these loans in May and they have income from PPP loan. It's not income, it's just cash, and then it's a liability. And it only becomes income to you from a book perspective. So like in QuickBooks or whatever you use to do your bookkeeping once it's forgiven. And then even once it's forgiven, we from a tax perspective will remove it from your tax return. It is not taxable to you. So I do see a lot of accounting, unless a lot of business owners, unless they have a specific bookkeeper who's helping them or they just know how to do it, a lot of times the first job I do as a tax professional is I look at your QuickBooks and I try to see and make sure it makes sense. You can tell a lot of things from QuickBooks or again, from Excel, whatever the person uses, and see if people are accounting for things properly. And oftentimes they're not, and things are not in the right place. And so that's our starting point from tax. You really want to get your books nice and clean, get that where you need to be, and then you go from there and you can start preparing your returns.